Have you ever wondered how companies raise money or why the news constantly talks about the stock market going up or down? Financial markets are the invisible engines that drive the world economy and your investments. In this video, we're going to break down what financial markets are, why they matter to you, and how they create opportunities for everyone. From governments and big corporations to everyday investors like you. So, what exactly is a financial market? In simple terms, financial markets are places, physical or virtual, where people buy and sell financial assets like stocks, bonds, commodities and currencies. They exist to bring buyers and sellers together. More importantly, they enable borrowers to directly secure funding from investors. So, financial markets provide opportunities for businesses, governments, and individuals to raise money, invest, and grow wealth. It is worth mentioning that in this context, the words buyers, lenders, and investors are interchangeable. Also, sellers, borrowers, and issuers have the same meaning. Now, why should you care about financial markets? Here are 3 key reasons. Firstly, because of capital allocation. Financial markets allow businesses to raise funds to expand. Whether it's a company launching new products or governments building infrastructure, markets provide the capital they need. In simple terms, they're avenues in which borrowers receive money from lenders. Secondly, wealth creation, which is the focus of Fathom Finance channel. As an investor, you can grow your wealth by investing in stocks, bonds, mutual funds, and so on. For example, buying shares of a strong company can give you dividends and capital gains over time. And thirdly, economic stability. Financial markets also help the economy run smoothly, for example, by providing price transparency, ensuring liquidity, and allocating capital more efficiently at lower costs. Having said these, now let's look at key players in financial markets. Governments issue bonds to fund public projects. Also, companies raise money through stocks and bonds. In addition, individuals and institutions invest to grow their wealth. And finally, we have banks and financial institutions. They act as intermediaries, helping money flow efficiently. So how does all of this affect you? Financial markets affect the public from different channels, but for the sake of this video, we can think of some examples. For instance, your retirement savings pension or mutual funds grow because of the stock and bond markets. Or, you can directly invest in the stock and bond markets to earn money. Or, when you buy a house, mortgage rates are influenced by bond markets. Now, let's finish off this video by talking about 2 main parts of financial markets, primary markets and secondary markets. Let's take a real-world example. Back in 2012, Facebook decided to go public and issue shares for the first time. This was done through an initial public offering, or IPO. In the primary market, new shares are created and sold directly to investors. In this case, investors bought Facebook shares directly from the company, and Facebook raised $16 billion to fund its growth. Once those shares were sold in the primary market, they began trading on the Nasdaq Stock Exchange. This is where the secondary market comes into play. In the secondary market, investors buy and sell shares among themselves. If you buy Facebook shares, or Meta Platforms as it's called today, you're not buying them directly from Facebook, you're buying them from another investor who wants to sell. So while the primary market helps companies raise money, the secondary market helps investors trade and stay liquid. To recap this video, financial markets are where money flows, assets are traded, and economies grow. Primary markets help raise funds, and secondary markets keep assets liquid. From businesses to individual investors, financial markets create opportunities for everyone. Thanks for watching. If you find this video worthy, please hit the like button and subscribe to fathom out more on finance. Next, we'll dive into the key differences between debt and equity markets.